Hey there, my name is John Stevenson. Welcome to the show. Today we're going to be talking about the differences between variable annuity contracts and fixed or fixed indexed annuity contracts. So, disclaimer here, I do not sell variable annuities because I'm not a licensed advisor for those, but they're not as popular right now as fixed indexed and fixed annuities because you can get a whole lot more from those, and you can also get a lot of market protection. Now, I say you can get a whole lot more from those. I mean, you can get a whole lot more as far as the interest rate's very high right now. You can get high income payouts, and you get a lot of market risk protection, 100% market risk protection, and you get a decent amount of the index. Now, with a variable side, though, and I'll share my screen here. I'm going to go through some numbers here with you. But with the variable side, these annuity contracts can be good as well, but the market conditions also have to be good. Okay. If the market conditions are bad, then these contracts go down as well. And so you have these contracts that are based off of market performance, and if the market's down, then your values go down as well. And so if you have an income rider on there, which a lot of times they will have an income benefit, some sort of lifetime guarantee, it's a lot lower than what you could get on the fixed side. So the fees, though, can be substantial as well. Not all of them charge a lot of fees, but a lot of them do. I looked at a guy's account last year that was doing, he had like $1.2 million in there, and he was getting charged 6% per year in fees. And he didn't realize that because he was thinking, he just kept telling me, well, I'm getting this 6% guaranteed growth, and then I'm getting all this that I might get, and he was wondering, why is my account balance not growing very well? And I looked at his statements, and I was like, well, it's because you've got an advisor fee here. You've got some mutual fund fees over here. And then you've got the annuity fees on top of that, right? So there's all these different fees, and he wasn't realizing that these fees were hidden in there, and they were. And so, anyways, they can definitely give you higher growth for sure. If the market's doing well, you can capture all of that growth and then maybe activate income on those later on as a lifetime payout. But it's not guaranteed. It's all hypothetical. And a lot of you who reach out to me don't want that. You're looking to protect your money, or you're looking for highest lifetime income, and you don't want it subject to market risk. So if you want it subject to market risk, you might as well just throw it in the plain stock market and not have any fees. Okay. So anyways, variable annuities can be valuable, but they just have limitations. They have limitations as far as protecting your money against risk. And of course, they do have a lot of growth potential, but it is just potential. Okay. So I'm going to share my screen because I want you to see this more visually so we can kind of work through these numbers together. And then you can kind of decide for yourself what's best for you. If you want to book a call and you're thinking about purchasing an annuity, I sell fixed indexed, fixed annuities, and income riders, SPIAs, DIAs, QLACs, all of the fixed side, the guaranteed side. I specialize in that. If you're looking for that, then book a call with me. There's a link below this video. It goes directly to my calendar, and we'll get on a Zoom call. Otherwise, you can go to my website and check out all of these annuities yourself, and you can run the numbers for yourself. And then if it makes sense, you can book a call with me there as well. Okay, that's johnstevenson.com. All right, so let's go to my screen, and I'm going to show you $700,000. This is for a client that is expecting 2% inflation. Okay, they have an income goal of around $71,000 per year. And we're looking at the last 25 years. Okay. If I go to like the 1929 stock market crash, it won't look as good, but I wanted to make this look as good as possible. Okay. I want to make these, I don't want to sit here and try to push you to buy an annuity. I'd love to sell you an annuity, but I want to be able to at least show the best 25 years we can kind of compare side by side. Okay. All right. So if we have withdrawals, we want 700. Total withdrawals here is 711,000 in withdrawals. Remaining balance is 0, and then it ended at age 75. So if you're planning on living longer than 75, this might not be a good scenario. But let's look at it. So if we look at this and see, all right, yearly withdrawals. Okay, you can see the value, and we're letting this grow a little bit. We're not taking it right now. And again, I'm comparing right now a variable annuity. Okay. I'm comparing even like a variable account, something that's subject to market risk. Okay, so if you look at that, this gives you the last 25 years. Here's what it would look like if it repeated itself, which often it does. If you put it all in and you have it reduce, during some years, then it's not going to do so well. Okay. But you're still going to have some big growth years. And then you're going to start taking income. And again, we wanted 71 grand. So we put a 2% inflation on here. And so then we had that rise every year. Oh my goodness. It's crazy. So the money runs out pretty quick. You have some years where it goes down, but then you have some really good years, lots of good years. And again, this is starting from the beginning. So like 2020 to 2025. And you can see some bad years. Obviously, we're in the beginning from the .com. But that can happen again. Okay. So now let's go over here and say, well, I don't want to account for inflation, or at least very much. So I'm going to bring this down a little bit more. And I'm going to make my money last longer. Okay, it's lasting to like 78. So that's not bad. It's a little bit better. So that's pretty good. And we're just looking at the last 25 years. Okay, so I'm not making up these numbers. That's just how that works. Now I'm saying, well, what if it's the worst 25 years? Well, there you go. That's looking at the stock market crash of 29. So this is actually looking at 1929 to 1954. So yeah, I usually don't want to look at that because that could happen, absolutely could happen. But I want to paint as rosy of a picture as I can for the stock market. I do still think an annuity would be the best option versus this. Could be a variable annuity. This could be a stock market account. But again, you can just see it's not a great thing when you see your money run out. And you do have some years where you make a ton of growth, and it's great. I love the growth in the market. But even with the growth, unfortunately, some down years can really, really hamper things and make your money run out. So anyways, not a great thing to think about. So then I look at that and say, okay, well, what if I want income from the same 700 grand? Let me go to 700 here. And I want to take it in 5 years. Look at this, 71,000. And that's guaranteed for life. The account balance doesn't last. The account balance goes down on this one as well. So look at this. You give it to the insurance company, the account balance is gone by the time you're 75. That's if there's no earnings at all. That's pretty extreme. Let's look at earnings. You're going to get some earnings. Okay, then the account balance is going to last you like 81. All right, but look at this. See the income? It never stops. You take out $2 million by the time you're 95. You live longer, you take out more. And that's because you gave it to the insurance company for 5 years to grow it. And they grow it with call options and with high interest environment that allow them to make a profit and allow them to guarantee this income to you. They also have mortality tables because they know exactly how long each one of us are going to live. They sell life insurance. They sell annuities. They know how long we all live. So it all evens out for them. And for us, it just equals peace of mind and a high lifetime pension payout. So I love that. It's really, really nice to have that. Now, this is with an income rider. Income riders have fees. You can see the fees being charged right here. Okay, you might, over that time, it's a lot of fees. You might get charged 70 grand in fees, but that's also probably giving you an additional 500 grand in income because if you didn't have the fees, they'll give you a lower lifetime income, but it's much lower. Okay, it's much lower. Like we're talking, well, let's look at it. I'm going to say no rider fee. Okay, I don't want to pay $70,000 in fees. Great. Well, it's 42,000. So it's like 30 grand or 29,000 less. So over 30 years, like $900,000 less. I'll tell you, I will gratefully hand over even $100,000 in fees if I can get 900 grand more in income. And that's what this is. So anyways, pay the fee. That's what I would recommend, but that's totally up to you. Okay. So let's compare to a fixed, just a straight fixed annuity. Okay. Fixed meaning a MIGA, like a fixed rate of return. Okay. So we'll look at that. And those are great too. I sell a ton of those because the rates are great. So if we look at 700 grand and let's say I want to live off of, well, let's see. This one allows 5%. This one allows interest only. So I want all the interest. So I'm just going to say I want to live off the interest. Okay, well, this is pretty straightforward. Then you can see right here, here it is. My first year earnings is 39 grand, 5.6 multiplied by 7%. So if I let it sit and compound, it's going to grow, 270 grand in earnings. Total growth or total account value is 970 grand. That's pretty good. So, but if I want to take out withdrawals, I can absolutely do that. I'll just show you right here. If I want to take withdrawals and I don't want to have any penalties for that, then I'll just do this. I'll show you what it looks like. There, earnings, withdrawals. Okay, get my 700 grand at the end of it. It's really simple. Okay, protects you against market risk, It gives you withdrawals, and you're able to take that income out. So that's pretty nice. It's not variable. Okay, you're not subject to market risk. It's just fixed. That's just how it works. So if you have a variable annuity where it earns 30% one year, you'll miss out that year, right? Because you would have taken out more. But if you have a year where the market's down, boy, you're probably going to wish you're in one of these. So I wanted to paint a picture on this because there are differences between these two contracts. It's nice to see the visuals as far as how this would look. And these numbers could be totally different for you. You might decide, well, I've got a special mutual fund, okay, and it gives me a floor of, where it doesn't allow me to lose more than this, okay, more than 6% a year. And then it allows me to earn, this much or whatever. Then, you might have different numbers to play with. But at the same time, if you have a bad recession, you have a lot of those bad years, that can still change things up where your account value maybe doesn't run out when you're 77, but it still might run out when you're 85. And if you're married and you want to make sure that money comes out for your spouse, the lifetime income, you might want to consider the income rider. Otherwise, look at the fixed annuity. What I'm looking at right here, this is great. Okay, you can do this. You can set up a fixed index annuity without an income rider and get a little bit more growth and still take out income that way as well. And that doesn't have the variable side. You're not going to make as much as the variable side, but you still make a decent amount. So if you want to talk about that and you're thinking, I'd like to purchase an annuity, how do I start? Book a call. There's a link below this video. It goes directly to my calendar. Otherwise, go to my website, check out my annuity calculators. You can book a call there as well. I'd be happy to help. I'd be happy to answer your questions. I'm not going to try to hard sell you, but I will show you what's available and I'll make some recommendations. So anyways, hope that helps. I appreciate you watching. If you like the video, if you like the channel, make sure you like, subscribe, share, comment below. I'd be happy to answer all your questions. I really appreciate you watching, and we'll see you next time.